Hello and welcome, and today's stock analysis video is Zoetis. Let's find out about the company. Zoetis was founded in 1952 and was later IPO'd in 2013. Zoetis provides and discovers animal care medicines and vaccines, as well as diagnostic products in the USA and worldwide. It markets its products to vets, livestock producers and pet owners. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. The earnings per share is up by 13% since last year. Now let's look at the free cash flow, which is the money a business can generate from its operations. And for their free cash flow, we can see the Zoetis is up by 25%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. And their revenue is up by 8%, which is just a little under the 10% I will be looking for. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. Their book value is up by 15%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. And their return on invested capital and return on equity looking brilliant at 20% and 47%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And their debt is a little higher than we would like, as it's going to take 4 years with their free cash flow to pay it off. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. The operating profit margin is a really strong 70%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Their operating profit margin is looking very strong at 37%. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. At 2.22, this is a little under our target. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. Our PE ratio is 31 and our enterprise value to EBIT is 25, which are both a little higher than we would like. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 6 super investors who own this company. If we look back at Terry Smith's previous purchase and sales, we can see that he has consistently been buying Zoetis. However, he has made some small sales. However, we can see that 6 super investors have been selling. Ray Dalio has consistently bought and sold Zoetis shares over the last few years. However, in the last 2 quarters, he's been selling at a nice profit. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. Over the last 10 years, Zoetis' shares have been going up nicely. They had a peak in 2021 and had a small drop in 2022, but they are on the rise again, but at a much slower pace. So let's see what the analysts think. On average, the analysts believe that the price target should be about $195, but some believe it can go as high as $230. Analyst reports suggest that Zoetis is currently at fair value or even perhaps a little cheap at the moment. And the overall analyst consensus is that Zoetis is a strong buy at the moment, and collectively the analysts believe that the company will continue to grow between 10 and 16% over the next 5 years. So I will use the current EPS of 5.01 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate an EPS of 15%. I'm going to give them a PE of 30. After that, I'm going to project these numbers forward by 10 years. Then this gives me an estimated future stock price of $615 per share for its future share price. Then we need to include our 15% return. And then we work out the current value that Philtown calls a sticker price, which is $152. And then we apply a margin of safety, and at 50% off, this gives me a buy price of $76. With a margin of safety at 20%, this gives me a buy price at $122. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. Using this model, it suggests that Zoetis is undervalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. Using the 10 cap model, it suggests that Zoetis is overvalued. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. At 25, it suggests that Zoetis is between fairly valued and overvalued. Finally, I've also included Philtown's earnings per share growth model that I used earlier. Using this model, it suggests that the current valuation is about right, but doesn't leave any margin of safety. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. In this next section, we're going to split the chart into different zones. Our first zone is a market bottom for Zoetis, which is about $134. Then we currently seem to be in zone 2, which is between $157 and $175. And then we come to zone 3, which is between $175 and $198. And finally, zone 4 is our potential exit strategy when the company becomes overvalued, with a target price of over $198. In this next section, we're going to find out what our potential return would be if we bought at today's price and at our 20% margin of safety. The return we would receive if we bought at $159 and sold at $200 would be 26%. We would see a return of 64% if we bought at our margin of safety price of $122 and then sold at $200. In this graph, we're going to compare the operating profit margin of Zoetis, Elanco, Bayer, IDEX and Novartis. By comparing the operating profit margins, we can see the relative performance between Zoetis and its similar competitors. The chart shows that Zoetis is better equipped and more efficient at generating profits from its core business activities than its competitors. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Zoetis scored an excellent 8.5 out of 12. Under ownership, 6 super investors have bought in the last few quarters and 6 have sold shares. In the past 3 years, we can see the average share price has trended up. Analysts are indicating Zoetis is a strong buy, and they are predicting they will grow between 10 and 17% over the next 5 years. Using the different valuation models, my personal buy price is about $122 with about a 20% margin of safety. My final overall rating is 3.5 stars out of 5, and I have given this a category B rating within my own stock watch list. In a later video, I'm hoping to share with you my current portfolio and the stocks that are on my watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.